There are hidden money traps everywhere in our economy that are systematically stealing your wealth, and you probably don't even know they exist. These aren't obvious scams or get-rich-quick schemes that you can easily avoid. These are subtle, sophisticated systems built into the modern financial landscape that transfer money from working people to wealthy institutions without most victims ever realizing what's happening to them. I've spent over 40 years in finance, and I can tell you that the biggest threat to your wealth isn't market crashes or economic recessions. It's these invisible traps that drain your money slowly, steadily, and permanently while making you think you're making smart financial decisions. The companies and institutions that profit from these traps have spent billions of dollars making them seem normal, beneficial, or even necessary. The most insidious part is that many of these money traps are marketed as solutions to financial problems or ways to improve your economic situation. They're packaged as products and services that responsible people use to manage their money better. But in reality, they're wealth extraction mechanisms designed to enrich financial institutions while impoverishing their customers. What makes these traps so effective is that they often provide small, immediate benefits while creating large, long-term costs that aren't obvious until it's too late. You feel like you're getting value or solving a problem, but over time, these traps destroy far more wealth than they create, leaving you financially worse off despite thinking you made good decisions. If you want to understand how wealthy people avoid these traps and why they keep getting richer while everyone else struggles financially, you need to subscribe to this channel right now, because recognizing and avoiding these money traps could be the difference between building real wealth and staying trapped in financial mediocrity forever. The first money trap is the retirement account trap that convinces people to lock up their money for decades in exchange for tax benefits that often disappear by the time they retire. Traditional 401k plans and IRAs are marketed as essential tools for retirement security, but they're actually wealth control mechanisms that benefit employers and financial institutions more than the employees who contribute to them. Here's how the retirement account trap works. You're convinced to contribute money to accounts that you can't access for 30 or 40 years without severe penalties. In exchange, you get modest tax deductions today and the promise of tax-free withdrawals in retirement. But this promise is based on assumptions about future tax rates, investment returns, and economic conditions that may not materialize. Meanwhile, your employer gets significant tax benefits for offering retirement plans while reducing their obligation to provide real pensions with guaranteed benefits. Financial institutions collect management fees on your contributions for decades, often totaling more than your actual investment returns. You bear all the investment risk while they collect guaranteed fees regardless of performance. The opportunity cost of retirement account contributions is enormous because you're tying up your most valuable asset, which is capital during your prime earning years, in accounts that prevent you from using that capital for wealth-building opportunities. Real estate investments, business ventures, and other alternatives often generate higher returns than retirement accounts while providing more liquidity and control. But the biggest problem with retirement accounts is that they're based on the assumption that you'll be in a lower tax bracket during retirement than during your working years. For anyone who builds serious wealth, this assumption is backwards. Successful people often face higher tax rates in retirement because their investment income and required distributions push them into high tax brackets. The retirement account trap also assumes that tax rates will remain stable or decrease over time, but anyone who understands government finances knows that tax rates must increase dramatically to service current debt obligations and fund promised benefits. You're likely deferring taxes from today's relatively low rates to tomorrow's much higher rates. The second money trap is the insurance trap that convinces people to buy financial products disguised as insurance that provide minimal protection while generating enormous profits for insurance companies. Whole life insurance, universal life insurance, and annuities are the worst examples of this trap because they combine poor investment returns with high fees and complex terms that favor the insurance company. Whole life insurance is marketed as a way to provide death benefits while building cash value that you can borrow against or withdraw during your lifetime. but the investment component of whole life insurance typically generates returns of 2 to 4% annually, while charging fees that often exceed 1 to 2%. You're essentially getting 0 to 2% returns on money that could earn 8 to 10% in basic stock market investments. The insurance trap works by making these products seem sophisticated and beneficial, while hiding their true costs and opportunity costs. Insurance salespeople are trained to emphasize the tax advantages and safety of these products while downplaying the low returns and high fees that make them terrible investments for building wealth. Universal life and variable annuities are even worse because they add complexity that makes it nearly impossible to understand what you're actually paying in fees or earning in returns. These products often have multiple layers of charges, including management fees, mortality charges, administrative costs, and surrender charges that can easily total 3 to 5% annually. The opportunity cost of insurance investments is massive because money tied up in these low-return products can't be invested in assets that actually build wealth. A 30-year-old who invests in whole life insurance instead of index funds will typically end up with hundreds of thousands of dollars less wealth by retirement age. The third money trap is the banking trap that convinces people to keep large amounts of money in savings accounts and certificates of deposit that pay interest rates below inflation, while the banks use those deposits to generate much higher returns for themselves. Banks market savings accounts as safe, responsible places to keep money, but they're actually wealth destruction vehicles during inflationary periods. When savings accounts pay 2% interest and inflation runs at 5%, you're losing 3% of your purchasing power annually. Over 10 years, this represents a 30% loss in real wealth, even though your nominal account balance might be growing slightly. Banks profit by borrowing your money at 2% and lending it out at 8 to 12%. The banking trap is particularly insidious because it preys on people's desire for safety and security. Banks spend billions on advertising that associates their products with stability and protection, while the fine print reveals that your deposits are actually losing value in real terms. Most people never calculate the opportunity cost of keeping large amounts in low-yield bank products. Certificates of deposit are even worse because they lock up your money for extended periods while paying returns that rarely exceed inflation rates. You give up liquidity and investment flexibility in exchange for slightly higher interest rates that still result in negative real returns after taxes and inflation. The banking trap also includes checking account fees, ATM fees, overdraft fees, and other charges that extract wealth from customers who need basic banking services. Banks have engineered these fee structures to generate maximum revenue from people who can least afford to pay them, creating regressive wealth transfer systems. The fourth money trap is the credit trap that convinces people that borrowing money for consumption is normal and acceptable while charging interest rates that make wealth building impossible. Credit cards, personal loans, and consumer financing are marketed as convenient ways to smooth out cash flow or afford necessary purchases, but they're actually wealth destruction mechanisms. Credit card companies profit from people who carry balances because they can charge interest rates of 15 to 25% on money that costs them 2 to 3% to obtain. A person who carries a $5,000 credit card balance at 20% interest will pay over $1,000 annually just in interest charges, while the principal balance barely decreases. The credit trap works by making minimum payments seem affordable while ensuring that most of the payment goes to interest rather than principal reduction. Credit card companies deliberately structure payment schedules to maximize interest income while keeping customers trapped in debt for decades. The compound effect of credit card debt is devastating because 20% interest rates compound against you while preventing you from investing money that could compound in your favor. Every dollar that goes to credit card interest is a dollar that can't be invested in assets that build wealth over time. But credit cards are just the beginning of the credit trap. Auto loans convince people to borrow money for depreciating assets while paying interest rates that exceed what the vehicles are worth within a few years. Personal loans and buy now, pay later services extend credit traps into every aspect of consumption, from furniture to vacations. The fifth money trap is the housing trap that convinces people to buy the most expensive home they can qualify for while loading them with mortgage debt property taxes, insurance, and maintenance costs that consume enormous percentages of their income for decades. The housing industry markets home ownership as wealth building and the American dream, but for most people, it's a wealth destruction mechanism. Here's how the housing trap works. Banks approve you for mortgages based on maximum debt to income ratios rather than optimal ratios for wealth building. Real estate agents encourage you to stretch your budget because their commissions increase with higher sale prices. Mortgage brokers get paid more for arranging larger loans regardless of whether those loans serve your financial interests. The result is that most homeowners buy houses that require 30 to 40% of their gross income for total housing costs, including mortgage payments, taxes, insurance, and maintenance. This housing cost burden prevents them from investing adequately for wealth building while tying up enormous amounts of capital in illiquid real estate. The housing trap is particularly insidious because rising home values create the illusion of wealth building, even though most homeowners can't access that wealth without selling their primary residence. Home equity represents locked up capital that generates no income and often appreciates at rates below stock market returns. Property taxes, insurance premiums, and maintenance costs continue rising throughout home ownership while providing no wealth building benefits. These carrying costs often total 2 to 3% of property value annually, representing a negative return on the capital tied up in home equity. The sixth money trap is the education trap that convinces people to borrow enormous amounts of money for educational credentials that often don't provide sufficient income increases to justify their costs. Student loans are marketed as investments in human capital, but they're often wealth destruction mechanisms that burden graduates with debt that prevents wealth building for decades. The education industry has inflated costs far beyond inflation rates by exploiting easy credit availability through government-sponsored student loan programs. Universities know that students can borrow almost unlimited amounts for education, so they've increased prices accordingly while providing educational value that often doesn't justify the costs. Graduate school debt is particularly devastating because it typically involves borrowing six-figure amounts for professional degrees that may not generate sufficient income premiums to cover the debt service costs. Many lawyers, doctors, and business school graduates spend decades paying off educational debt while earning incomes that could have been achieved through less expensive educational paths. The opportunity cost of educational debt is enormous because money spent on student loan payments can't be invested during the most valuable years for compound growth. A 25-year-old with $100,000 in student debt will often accumulate hundreds of thousands of dollars less wealth over their lifetime compared to someone who avoided educational debt. The seventh money trap is the investment trap that convinces people to pay high fees for actively managed mutual funds, complex investment products, and financial advisory services that typically underperform simple index fund strategies while extracting wealth through management fees and transaction costs. Financial services companies profit enormously from convincing people that investing is complicated and requires professional management. They create complex products with high fees while marketing them as sophisticated solutions for wealthy investors. In reality, these products typically underperform simple, low-cost alternatives while enriching the financial services companies. Actively managed mutual funds charge fees of 1 to 2% annually, while historically underperforming index funds that charge fees of 0.1% or less. Over investment lifetimes, these fee differences compound into hundreds of thousands of dollars in reduced wealth for investors who pay high fees. Financial advisors often charge additional fees of 1% annually while recommending the same high-fee investment products, creating multiple layers of fees that devastate long-term investment returns. Many financial advisors are essentially salespeople for investment products rather than objective advisors working in their clients' best interests. The eighth money trap is the subscription trap that convinces people to pay recurring monthly fees for services they rarely use or could obtain for free. Subscription businesses have exploded because they generate predictable revenue streams while customers often forget about services they're paying for or underestimate the total annual costs. Gym memberships, streaming services, software subscriptions, meal delivery services, and countless other recurring payment schemes extract wealth from consumers who sign up during promotional periods but continue paying long after they've stopped using the services. Many people pay hundreds or thousands of dollars annually for subscriptions they could easily eliminate. The subscription trap works by making individual monthly payments seem small while the annual totals become substantial. A $10 monthly subscription costs $120 annually, but most people focus on the monthly amount rather than the annual commitment or opportunity cost of investing that money instead. Subscription services also make cancellation deliberately difficult through complex procedures, automatic renewals, and customer retention tactics designed to prevent people from ending subscriptions they no longer want or use. Companies profit by making it easier to start subscriptions than to stop them. Now let me show you how wealthy people avoid or exploit these money traps while building wealth through alternative strategies. The key insight is that wealthy people understand that most financial products and services are designed to transfer wealth from customers to providers rather than helping customers build wealth. Instead of contributing to employer-sponsored retirement plans with high fees and limited investment options, wealthy people often maximize tax-deductible contributions to get employer matches, then invest additional capital in taxable accounts with more flexibility and better investment options. They maintain control over their money while optimizing tax benefits. Instead of buying whole life insurance or annuities, wealthy people buy term life insurance for protection and invest the difference in assets that generate much higher returns. They separate insurance from investing because combining them benefits insurance companies more than policyholders. Instead of keeping large amounts in savings accounts, wealthy people maintain minimal bank balances while investing in dividend-paying stocks, real estate investment trusts, and other assets that generate income exceeding inflation rates. They understand that cash is a depreciating asset during inflationary periods. Instead of borrowing money for consumption, wealthy people use debt strategically to acquire appreciating assets while avoiding consumer debt completely. They understand that debt can be a wealth-building tool when used correctly or a wealth destruction mechanism when used for consumption. Instead of buying the most expensive house they can afford, wealthy people often buy modest homes with significant down payments to minimize carrying costs while investing the difference in appreciating assets. They treat housing as a consumption expense rather than a wealth-building strategy. Instead of borrowing money for education, wealthy people often choose educational paths that provide good returns on investment while minimizing debt. They understand that educational credentials are valuable only to the extent that they generate income increases exceeding their costs. Instead of paying high fees for investment management, wealthy people often use low-cost index funds or direct stock ownership to maximize their investment returns while minimizing fees that erode wealth over time. Now let me give you the exact strategy for escaping these money traps and redirecting the money you're losing toward genuine wealth-building opportunities. Because recognizing these traps is worthless unless you can systematically eliminate them from your financial life while building alternatives that actually create wealth. The first step is conducting a complete financial audit to identify exactly how much money you're losing to these traps annually. Add up all your retirement account fees, insurance premiums for investment products, bank fees, credit card interest, subscription costs, and investment management fees. Most people are shocked to discover they're losing thousands of dollars annually to these wealth extraction mechanisms. For retirement accounts, request fee disclosure documents from your plan administrator and calculate the total annual cost, including management fees, administrative fees, and expense ratios for your investment options. Many employer-sponsored plans charge fees totaling 2 to 3% annually when you include all the hidden costs. For insurance products, review your whole life or universal life policies to understand exactly what you're paying in premiums versus what you're earning in cash value growth. Most people discover they're earning negative real returns after accounting for inflation and opportunity costs. For banking relationships, calculate how much you're losing to low interest rates on savings accounts and certificates of deposit compared to inflation rates and alternative investment options. Add up all the fees you're paying for checking accounts, ATM usage, and other banking services. For investment accounts, review all management fees, expense ratios, and transaction costs across your portfolio. Include fees you're paying to financial advisors, mutual fund companies, and brokerage firms. These fees compound against you over time and often exceed several percent annually. The second step is creating a systematic elimination plan for the most expensive money traps while building alternative wealth building strategies. Start with the highest cost traps first because they're destroying the most wealth and offer the biggest immediate benefits from elimination. If you're paying high fees in employer retirement plans, contribute only enough to capture full employer matching, then redirect additional retirement savings to low-cost IRAs or taxable investment accounts with better options. You still get tax benefits while reducing fees and increasing investment flexibility. If you have whole life insurance or annuities, consider surrendering these policies and investing the cash value plus future premiums in low-cost index funds or dividend-paying stocks. The improved returns typically more than compensate for any surrender charges within a few years. If you're keeping large amounts in low-yield bank accounts, gradually move excess cash into higher-yielding alternatives like treasury bills, money market funds, or dividend-paying stocks that provide inflation protection. Maintain minimal bank balances for liquidity needs only. If you're carrying credit card debt, prioritize elimination through aggressive payments or balance transfers to lower rate options. Every dollar of credit card interest you avoid can be redirected toward investments that compound in your favor rather than against you. If you're paying high investment fees, transition to low-cost index funds or direct stock ownership that reduces total fees below 1% annually. The fee savings alone often improve returns by 2 to 3% annually without any additional risk. The third step is building alternative wealth creation systems that provide superior returns while avoiding the trap mechanisms that benefit financial institutions more than individual investors. Focus on simple, low-cost strategies that you can understand and control directly. Direct stock ownership in dividend-paying companies eliminates mutual fund fees while providing growing income streams that exceed most fixed income alternatives. Companies like Johnson & Johnson, Coca-Cola, and Microsoft have raised dividends for decades while providing total returns that significantly exceed retirement account options. Real estate investment through REITs provides inflation protection and steady income without the complexities and costs of direct property ownership. REIT index funds offer diversified real estate exposure at low costs while providing liquidity that direct real estate can't match. International diversification through low-cost international index funds provides currency protection and exposure to faster-growing economies while reducing dependence on U.S. market performance. This geographic diversification improves risk-adjusted returns over long investment periods. The fourth step is developing systems that prevent you from falling back into money traps through automated investing and spending controls. Set up automatic transfers from checking accounts to investment accounts that redirect money before you can spend it on consumption or fall prey to marketing for financial products. Use direct deposit to split your paycheck between minimal amounts for checking accounts and larger amounts that go directly to investment accounts. This automation prevents lifestyle inflation and ensures consistent wealth building regardless of your emotional state or external pressures. Set up automatic subscription audits every 6 months where you review all recurring charges and cancel services you're not actively using. Treat subscription services like any other expense that must be justified by the value they provide relative to their costs. The most important psychological element is understanding that these money traps persist because they benefit powerful financial institutions that spend billions of dollars marketing them as beneficial or necessary. Recognize that avoiding these traps requires going against conventional wisdom and social pressure. Most financial advice you receive from banks, insurance companies, and investment firms is designed to generate profits for those institutions rather than wealth for you. Develop skepticism about financial products that seem too complex to understand or that provide primary benefits to the companies selling them. The compound effect of avoiding money traps while building alternative wealth strategies becomes enormous over investment lifetimes. Money that would have been lost to fees and poor investments compounds at much higher rates when deployed in wealth-building assets. But the transition from trapped to wealthy requires patience and discipline because the benefits develop gradually, while the money traps provide immediate gratification or false security. Stay focused on long-term wealth building rather than short-term comfort or convenience. Here's your immediate action plan. This week, complete the financial audit to quantify your current losses to money traps. Next week, begin eliminating the highest cost traps while setting up alternative investment systems. Within 3 months, redirect all money previously lost to traps toward genuine wealth building strategies. Track your progress monthly by calculating how much money you've stopped losing to traps and how much you've redirected to wealth-building investments. The combination of eliminating wealth destruction and implementing wealth creation creates accelerated progress toward financial independence. The most important insight is that building wealth isn't primarily about earning more money. It's about avoiding the systematic wealth destruction mechanisms built into modern financial systems while implementing simple strategies that actually compound wealth over time. If this analysis has opened your eyes to how money traps are keeping you poor, share this video with anyone who needs to understand how financial systems really work. Subscribe to this channel for strategies that wealthy people use to avoid these traps while building real wealth. Leave a comment below and tell me which money trap has been costing you the most money and what steps you're taking to eliminate it. The community of people who understand these wealth destruction mechanisms needs to support each other against industries designed to keep us financially trapped. Remember, every dollar you stop losing to money traps is a dollar that can compound in your favor for decades. The cumulative effect of these changes will determine whether you build genuine wealth or remain trapped in systems designed to enrich everyone except you.